Imagine investing just $100 today and watching it quietly grow into thousands of dollars over the next 20 years. That's not a fantasy. It's exactly how millions of ordinary people build wealth. The problem is, most beginners never get started. They think investing is too risky, too complicated, or only for rich people. None of that is true. If I had to start from zero in 2026 with no investing experience and only $100, I'd follow a simple step-by-step strategy. By the end of this video, you'll know exactly what that strategy is, and you'll avoid the mistakes that cost beginners thousands of dollars. Most people don't avoid investing because they don't care about money. They avoid it because they're afraid of making a mistake. Maybe you've heard stories about someone losing everything in the stock market. Or maybe you've looked at charts full of green and red lines and thought, this is way too complicated. But here's the truth. The biggest risk isn't starting too early. It's waiting too long. Every year you delay investing is another year your money misses the opportunity. Before you invest, you need to understand one simple idea. A stock represents a small ownership stake in a company. When you buy a share of a company like Apple or Microsoft, you're becoming a tiny part owner of that business. If the company grows, earns more profits, and investors value it more highly over time, the price of your investment can increase. Some companies also pay dividends, which are cash payments distributed to shareholders. The stock market is simply the marketplace where buyers and sellers trade those ownership shares. You're not gambling. You're investing in businesses. That distinction is important. Before buying your first investment, protect yourself first. If an unexpected expense forces you to sell investments during a market downturn, you could lock in losses. That's why many financial planners recommend keeping several months of essential expenses in an emergency fund before investing aggressively. Think of it as your financial safety net. A brokerage account is simply the platform that lets you buy and sell investments. Many brokerages today allow you to start with very little money and offer commission-free trading on many investments. When choosing one, consider factors like low fees, ease of use, investment choices, customer support, educational resources. For most beginners, keeping things simple is better than chasing advanced features. This is where many beginners make their first major mistake. They hear about a hot company online, a friend recommends a stock, or a social media influencer claims a company is guaranteed to explode. Instead of buying random companies, many long-term investors start with broadly diversified index funds, or ETFs. These funds spread your investment across many companies, rather than relying on just one. That means you're not betting your future on a single business succeeding. You're investing in the broader market. Historically, diversified investing has helped many investors reduce company-specific risk while participating in long-term market growth, although past performance does not guarantee future results. Here's something surprising. The amount you invest matters, but consistency often matters even more. Imagine investing a fixed amount every month, regardless of whether the market is up or down. Sometimes you'll buy when prices are high, sometimes you'll buy when they're lower. Over time, this approach can help smooth out the average price you pay. This strategy is commonly known as dollar cost averaging. It removes emotion from investing. One of the biggest mistakes beginners make is checking their portfolio every day. The market moves constantly. Some days it rises, other days it falls. That's normal. Successful long-term investors generally focus on years, not days. Temporary declines are a normal part of investing. panic selling after a market drop has historically hurt many investors more than the drop itself. Let's quickly review the mistakes you should avoid. Buying stocks because they're trending, trying to get rich overnight, following social media hype without doing research, selling after every market decline, waiting for the perfect time to invest. The perfect time rarely arrives. Many successful investors simply start with a plan and stay consistent. If I had no investing experience, this is exactly what I'd do. I'd build an emergency fund, open a reputable brokerage account, invest regularly, start with diversified investments rather than chasing individual winners. Ignore short-term market noise. Continue learning while staying invested for the long term. It isn't exciting, but wealth rarely comes from excitement. It usually comes from patience and consistency. Investing isn't about predicting tomorrow's stock prices. It's about giving your money the opportunity to grow over time. You don't need to be an expert. You don't need thousands of dollars. And you don't need to find the next big stock. You just need a simple plan and the discipline to follow it. If this video helped you understand how to start investing, the next step is learning which investments beginners should actually choose. In the next video, we'll break down ETFs, index funds, and individual stocks so you can understand which approach best fits your goals.